Taxes can be very confusing. Sometimes it feels like people who create these tax laws want us to be confused. To get a rough idea of how many people actually understand our tax system, I asked a simple question on my Facebook page. The question was, if you earn $100,000 in 2023 and you fall in the 24% tax bracket, how much do you think you will owe in federal income taxes? A lot of answers were $24,000 in taxes, which was no surprise because many people just make the mistake of simply multiplying $100,000 by 24%. However, this is a big misunderstanding. In the US, we follow the system called a progressive tax system. To better understand what this means, let's explore it a bit further. First of all, we need to understand what standard deduction is. What is standard deduction? A standard deduction is the part of your income that you don't have to pay any taxes on. It helps you lower your tax amount. The IRS will usually adjust the standard deduction for inflation each year. In 2023, the standard deduction for single filers is $13,850. So you do not have to pay any taxes on the first $13,850 of your income in 2023. This number is important and you will see why. Next, we need to understand the difference between marginal and effective tax rate. We will first start with marginal tax rate. A marginal tax rate is the tax rate applied to the last dollar of your income earned. The simplest way to understand this is with an example. Let's say in 2023, you make $113,850. Now remember that we discussed that the standard deduction is $13,850 for single filers. This is the part of your income that is not taxed. So $13,850, which is your income, minus the standard deduction, which gives us a nice round figure of $100,000. This is the part of your income that will be taxed. Now, looking at the tax brackets for 2023, for the first $11,000 of your income, the marginal tax rate is 10%. This means that the first $11,000 will be taxed at 10%. For income between $11,001 and $44,725, the marginal tax rate is 12%. So the income between these two numbers will be taxed at 12%. And the same calculation applies to the other two brackets as well. So if you make $113,850, the 24% marginal tax rate applies only to the last part of your income within the highest tax bracket. This does not mean that your entire salary is taxed at 24%, which is a very common misunderstanding. This method of taxation is known as progressive taxation. Now, the effective tax rate, on the other hand, is the average rate at which a taxpayer's total taxable income is taxed. This provides a more comprehensive view of the overall tax burden. To calculate the effective tax rate, we sum up the taxes paid in each tax bracket and divide by the total taxable income. So, tax on the first $11,000 is taxed at 10%. So $11,000 multiply that by 10% equals $1,100. Next, tax on the incomes between $1,101 and $44,725 is 12%. And you continue this calculation for the other two brackets as well. And finally, you add the taxes paid in each bracket. The total tax is $1,100 plus $4047 plus $11,143 plus $1,110, which equals $17,400. So your effective tax rate is simply dividing the taxes paid by the adjusted gross income, and that is 17.4%. So the marginal tax rate is 24%, but their effective tax rate is just 17.4%, reflecting the average rate at which their entire taxable income is taxed. The effective tax rate is lower than the marginal tax rate because of the progressive nature of our tax system, where higher tax rates only apply to a portion of the income within specific brackets. Let's do another example for someone who is earning a salary of $63,850. Taking the standard deduction out, the taxable income is $63,850 minus $13,850, which equals $50,000 of taxable income. For the first $11,000 of income, the marginal rate is 10%. For incomes between $1,101 and $44,725, the marginal rate is 12%, and so on. Since $50,000 fall in the third bracket, the marginal tax rate for someone earning $63,850 is 22%. The effective tax rate is $6,308. Divide the whole thing by $50,000, which equals 12.6%. So for someone earning $63,850, the marginal tax rate is 22%, reflecting the rate applied to the last dollar of their income within the third bracket. The effective tax rate, which represents the average rate you pay on your total taxable income, is 12.6%. Once again, The effective tax rate is lower than the marginal tax rate due to the progressive nature of the tax system. Now, you do not need to do all this math. Online calculators will give you the same answer without all this extra effort. However, understanding how marginal and effective tax rate work help clear any confusion about being taxed at a flat rate, which, as I've explained, is not accurate. Over the past 100 years or so, the brackets and the rates for federal income tax have changed a lot. Long time ago, it started with 7 brackets, but by 1920, it went up to as much as 50 brackets. From then until 1970, there were always at least 20 brackets. In 1986, a big tax reform reduced the brackets from 16 to 2. However, over the past 30 years, it increased again to the current 7 brackets. Furthermore, the top federal income tax rate has also changed quite a bit over the years. Back in the early 60s, it was as high as 91%. Imagine a marginal tax rate as high as 91%, something that is unheard of these days. It was then lowered to 70%, and then in 1981, they dropped it even more to 50%, and after the 1986 tax reform, it went all the way down to just 28%. Currently, it sits at 37%. I hope you have a better understanding of the tax code. If you're wondering why the tax system is designed this way, it's to ensure that people with lower incomes don't have to bear too much of the cost of government services. In a progressive tax system, those who earn less pay less taxes, and those who earn more pay more taxes. This helps the government collect more tax money from those who can afford it. And whether you agree with it or not, that's the intent or the purpose of a progressive tax system, and it's likely going to stick around.